Okay, so I have this script idea for a future episode for the channel, but today I wanted to give it a little test run by just reading it off of my notes. So today's note is called the 5 W's of investing. You have a dilemma. You want to learn how to get started with investing, so you look to the top investors to learn from their success. The only problem is they are so advanced that everything they say, every concept, all the financial jargon, it all sounds like gibberish to you because you're just getting started. That's the problem I'm trying to mitigate with these videos. I want to take everything I'm learning and break it down into simple terms for anyone just starting out. Now, I might not personally be a millionaire yet, but maybe the fact that I'm in a similar stage as you makes it easier to help you along the way. Investing is a lifelong practice, and although it can be painfully complex, starting small can still produce life-changing results. That said, today I want to introduce a concept I like to call the 5 W's of investing. In storytelling, we have the 5 essential elements that shape every narrative: who, what, when, where, why, the 5 W's. These questions lie at the core of what makes any story interesting and compelling. As it turns out, these same principles apply to the world of investing and capital markets. Before making any investment, we should be able to clearly define these 5 W's of investing. The first W is who. At the end of the day, all markets, all asset classes are driven by people, which really means that all investing is rooted in psychology. The who of investing is critical both for getting an intuitive feel for what we call market sentiment, and more importantly, unpacking what it is about ourselves that is drawn to this particular investment. Who is investing in this asset? Who stands to benefit from its success? Who stands to benefit from its collapse? What demographic is providing attention and resources to this particular market environment? Defining the who takes a lot of time and research, so start with yourself. If you were observing yourself from the inside out, what assessments would you make? What's your personal demographic, your socioeconomic status? When it's all said and done, what are you after as a consumer, and what do you value as a person? So I'll go first, just as an example. I'm currently an lower class white male in the service industry, trying to buy more time and freedom while providing a basic, comfortable living standard, with a focus on preserving my energy assets from rising inflation. As a consumer, this means I reduce spending whenever possible in order to invest, focusing on Bitcoin and other deflationary crypto assets as a means to counteract future price inflation. If I make a bet that more money will be printed in the future and that the inflation of the money supply will result in higher Bitcoin prices, then I'm incentivized as a consumer to buy at Bitcoin whenever it's undervalued. I can try to gather a sense of how the who is feeling in order to identify when an asset might be overvalued. The next W is what. The what of investing is often the most overlooked for the fact that it appears to be the most self-explanatory. Oh, I bought Apple stocks, so I own a part of the company, right? What does that mean to you? What makes this a worthwhile investment? And what is the practical use case? Here's where we dip into the fundamentals of investing. When you consider an investment, you analyze the mechanics, the interworkings of the thing you're buying. People often use the term investment vehicle for a reason. It provides a clear analogy. You can buy a Honda Civic for its reliability and its cheap replacement parts, or you can buy a Tesla for its self-driving capability. Whenever you buy any product or investment, you're making a judgment call based on the result you're aiming for. When considering a stock, you might consider the stock price as compared to the company's quarterly earnings. In percentage terms, how much are you actually making in dividends per quarter compared to how much you put in? You might consider what the company actually supplies and whether or not that product will be in higher or lower demand within the time frame you're looking to invest. Along with the fundamentals, learning the basics of tokenomics will go a long way as you apply those principles toward building your portfolio. To start, you want to be able to answer the question, what is the fundamental use case of this asset? What exactly am I buying? Next up is when. The when is the easiest one to start with visually and arguably the hardest one to master. On the surface, most people simply look at today's prices, then look at a chart of the asset's previous performance. The when is where we dive into technical analysis, or TA, which is basically a fancy way of saying that we are observing patterns and making guesses. We can imagine day traders stuck at a screen all day with prolonged sleep deprivation, and for most of us, that is not the life we're after. While understanding market activity can be a lifelong undertaking, it only takes a few weeks to learn some of the basic chart patterns in order to understand the framework of market psychology. Why do prices spike and crash? It boils down to human survival instincts based on resource scarcity and time scarcity. If you can observe the chart as if it is the combined behaviors of all the people bidding for that particular resource, you start to recognize patterns for unsung opportunities. To start, most research points toward making a slow, steady monthly investment into the right assets to mitigate the challenges of timing the market. Even then, if you're investing in a declining asset, dollar cost averaging won't help you, which is precisely why satisfying all 5 W's is vital. Truth is, we all want to buy low, sell high, make those profits, but it's mathematically impossible for everyone to be a winner at the trading game. So again, start small. Focus on the skills of analysis more than the activity of trading. The when of your investment time horizon plays a huge role in determining your portfolio's risk tolerance as well as its compounding rate of return. As they say, time in the market beats out timing the market. Now we've arrived at where. The where is both the least and most important element of investing. Where determines a lot. Depending on your location, you might be subject to certain regulations and restrictions. With the majority of investment taking place over the internet, it's important to have a global mindset. Where can investors access the asset you are investing in? Where can trade take place? And where does the asset reside? For instance, you think you own a stock, but can you use that stock anywhere except within the exchange you're using? Where is the underlying asset and who has control over it? If you have an investment property, the location will be subject to varying taxes, HOA fees, and other market conditions. If you have this incredible beachfront property, but it's only accessible by helicopter, then the where on your investment immediately limits your demand pool to the ultra wealthy who may or may not be attracted to your humble 2-bedroom bungalow. The where greatly affects movement of resources and therefore the usability of your investment. The final W is why. The why is what we call the investment narrative. What's the story behind the investment? Why are people interested? Why is the use case of the investment so compelling? When someone invests in Apple stock, they might think, well, these are the most compelling smartphones. But beyond that, what is compelling about your participation in the company? Is it the upside potential? What's the track record of the stock's performance? versus revenue versus dividends. The company might be producing great products, but why is your involvement necessary? When you have a stake in a particular ecosystem, you want to make sure that your level of investment is in direct proportion to the way you stand to benefit if your investment thesis plays out as anticipated. The why will be one of the most crucial factors to your investment plan and will keep you on course when markets crash unexpectedly or otherwise throw you off your equilibrium. The why turns reactive emotional trading into slow, measured energy preservation. Within the past few minutes, we've covered a brief overview of the 5 W's of investing, the 5 basic elements of every story. And as you've noticed, we've left out one of the most essential devices, how. The how of investing is where we click the buttons and actually move the imaginary numbers around Severance style so that we can start making real progress. We'll get to that in future videos, but it's important to remember that there is no perfect cut and dry copy and paste method of investing, mainly because each investment path is as unique as each individual. So if you feel clueless, remember to practice patience and curiosity. Most of investing has little to do with how often you trade. It has much more to do with strategic discipline compounded over time. Focus on educating yourself and it'll start to make more sense. The hardest part is the next step. So keep going. And that's today's note.